And
oh, now it's recording.
And I see it recording.
It's recording now.
Yep. Yeah. So I'm just gonna, you guys are fine. I'm just gonna leave it open.
Okay. Thank you. Good day, Commercial Board of Realtors. My name is Tosha Tabron, the Senior Vice President for Real Estate Lending at Invest Detroit, native Detroiter. I have a 20-year career in community development financing and philanthropy, serving the banking industry that 20 years. And before being at Invest Detroit, I spent a number of years funding what you'll learn more about, which is CDFIs, nonprofits in the Detroit space. And in my most recent role before Invest Detroit, I led philanthropy for JP Chase. And JP Chase is one of our largest funders at Invest Detroit. And I would like to turn the floor over to my co-presenter today, Jason Paulateer.
Thanks, Tosha, and good day, everyone. My name is Jason Paulateer, and I am the market manager for community and economic development at Fifth Third Bank with responsibilities for Indiana, Illinois, and Michigan. I joined Fifth Third Bank in November of 2018 after having a number of years. I'm not going to give the number like Tosha did in the banking industry in various positions, from community development lending to commercial real estate lending, small business, and retail branch management. And I am excited to be here with you guys today to share some information about our respective organizations with the Commercial Board of Realtors. And so, real quick, just to jump into it, I'm going to turn it back over to Tosha. But Tosha, what can you tell us about Invest Detroit and CDFIs in general?
Jason, thank you for being such a great partner and for asking the question. Happy always to talk about the work at Invest Detroit. And so let's jump right in here. Today's session obviously is about the age of COVID-19 and how lending looks. And I'd like to just give you a little bit of a snapshot of the work that Invest Detroit has done as a catalyst in the Detroit market in the region. And then we'll take it from there. We'll talk a little bit more about other CDFIs in the region and what they're doing. So who is Invest Detroit, as Jason has kind of asked the question here? Who is Invest Detroit? We are a financial catalyst. At least that's what we call ourselves. We've put in about $230 million in capital, and that includes tax credit allocations of dollars into the marketplace. That work has been done in partnership with a number of organizations, both private, like a Fifth Third, public, like our City of Detroit partners, and then a number of our philanthropic partners that serve the Detroit region. In total, we've done about $317 million in the 20-year span, and that has allowed us to leverage about $2.1 billion in that 20-year period. So I think we've been a catalyst if you look at it from that perspective. The 4 program areas that Invest Detroit covers within our work to catalyze economic growth: real estate, which is what we'll focus a lot of time on today. But we also do lending in commercial and industrial space. We have moved into doing loans in the small business space. And about 7 or 8 years ago, we were asked to consider creating a venture arm of our organization. And we also do lending in that space as well. The 4 goals is to create density in the marketplace, create jobs, create neighborhoods that are thriving, and then within that, always have a lens towards inclusivity. So I went through those pretty quickly, but this is just another snapshot of what those catalyzing economic growth means for us. We've done a lot of our real estate lending to support commercial investments in commercial corridors, but we also support multifamily and real estate investments. And we'll talk a little bit more about the Strategic Neighborhood Fund, which is very geographically focused within the city of Detroit. And then these are the other 3 arms of our work that support the work that we started in real estate development. More on Invest Detroit. Again, these are the four goals that we have that I talked about earlier: attracting more people to the city of Detroit, growing more job opportunities for residents, working within the city of Detroit to support neighborhood improvement. And then here's what we consider inclusivity: affordable housing that ensures that people of color, women, immigrants have an opportunity to participate in the city's economic growth overall. Jason hasn't asked that question, but I do want to jump right in to let you know what a CDFI is, right? So Invest Detroit is a CDFI, but we have other tools in our toolbox. But I think I want to start by giving you some perspective on what a CDFI is. It's a designation by the U.S. Department of Treasury. We get funding from the U.S. Department of Treasury. And because of that funding, it causes us to specialize our financing to serve low to moderate income communities. We are basically an alternative lender to the banking institutions. We can go deeper into the marketplace because we're less regulated than our traditional banking partners that you'll hear more about later. And one of the things that CDFIs can do is offer these products with very flexible terms than our traditional lending friends. And when we look at this, we're supporting individuals that are making less than the area median income. And those certified CDFIs, like ourselves, we provide educational services like business planning, we do credit counseling, we provide homebuyer classes, as well as lending support and other resources to the borrower. You want to learn more about CDFIs? I put a site here. The CDFI Fund is the organization that created us, and it provides information about our CDFI, which is a loan fund, as well as other types of CDFIs that you'll see in the marketplace. And I did provide some information here about the different types of CDFIs that are certified within the state of Michigan. There are banks. There is one CDFI bank in the state of Michigan. There are a number of credit unions that are member organizations. They actually take in deposits. So banks and credit unions actually take in deposits, as well as provide flexible lending products into the marketplace. There are loan funds like us, a lot of loan funds. And as you can see, these are usually nonprofit organizations. They provide technical assistance. They have micro products. They have affordable housing products. They support different types of developers, including affordable housing developers, and they are community service organizations. Loan funds normally do not take in deposits like banks and credit unions. And then there's venture capital funds. And these organizations can provide equity and debt with equity services to businesses in distressed neighborhoods. In the Michigan market, there are 37 Michigan CDFIs. 13 loan funds like Invest Detroit that depend on traditional banks for lending capital. Jason will probably get into talking about CRE lending a little bit later, and it helps fuel Invest Detroit and other CDFIs. Loan funds depend on these traditional banks to help give us capital so that we can lend it in the marketplace. The total CDFI funds, we've had a pretty substantial amount of rewards that have come from the U.S. Treasury in the form of grants and technical assistance grants that support our organization since 1996. Across the market, that's totaled over almost $60 million. New markets tax credits, we won't talk a lot about that in this class today, but this type of incentive to help development in the marketplace is a very sought out incentive across the nation. And I wanted to give you a perspective of how sought out. In the last number of years, we've had $639 million in rewards to the Michigan market. That accounts for like 20% of the awards that have been given from the national pot. That's pretty significant when you think about all the states that compete for this tool. If you want to learn, again, more about this tool and other things that are happening in the Michigan market, I've given you a website to go to learn more about Michigan CDFIs and new markets tax credits. CDFI.org/Michigan. Just so you can take a snapshot of this, for those who are across our wonderful state of Michigan, I've listed all of the Michigan CDFIs here. There's only one bank, the First Independence Bank in Detroit, and then by category, these are the credit unions. This first page is credit unions across the state. Here are more. And then here are all of the loan funds, including Invest Detroit right here. So we have made it to our next agenda item. I'd like to talk to you a little bit about money. I know this is where the rubber meets the road with a number of you want to know how these CDFIs work in the marketplace and how Invest Detroit kind of sits in that space. Right now, and I'll talk about how this looks in the age of COVID later, but right now, these are some of the products that we offer, and these are the products that our CDFI partners across the state also offer. We can do basically beginning to end in any type of real estate transaction, starting with the idea, the pre-development loans. How do we plan? How do we support the design or any early needs, soft costs that come into a project? We can provide pre-development loans up to $500,000, which is pretty significant. Most of our CDFI partners don't dabble in the pre-development loan space at that level. They are secured, that is secured lending. So we are looking for, which is the next bullet, land control, or we can offer a product of acquisition lending to help acquire that building or that land that you're ready to develop. In addition, CDFIs, including Invest Detroit, can support with construction loans. We can do ground up lending or provide dollars for renovation of a building. The other product that we can offer alongside with our pre-development acquisition and construction loans, bridge financing. So to solve for timing issues around grants, a number of times other subsidies are required into a project but don't necessarily come in at the beginning of the project as equity. We can provide a product called a bridge loan to get you to the point in which a grant is actually coming into play, or the subsidy dollars are actually available for the project. We do provide those up to $2.5 million for any particular project. And sometimes those bridge loans are to leverage government programs, which is the next bullet. New markets tax credits or bond programs are just examples of the type of leverage government programs that we can also provide lending to bridge, or we actually are a CDE who administers new markets tax credits as a product source for us, for our program, for our developments. There's term lending involved at the real estate stage or after the project so mortgage financing, or at the point in which we're looking to support a small business that'll go into one of our buildings, one of our newly renovated real estate buildings. We can also support and provide term loans to that small business. We provide working capital to those small businesses, and we can also provide them with tenant improvement loans. It's not here, but that is one of the other products that is available to a small business who wants to get involved in a newly developed real estate project that may be white box that they're going into. And then lastly, equipment loans. We can provide the equipment loans that will help you purchase equipment and machinery that will be used in that small business as a part of the complete real estate development project. And this is similarly offered at other CDFIs. As a matter of fact, this idea of how to lay this out for you came from one of our good partners, Capital Impact Partners, who provides all of these types of products as well. So we have a number of realtors on that'll be watching this program. So I would love to talk about the one thing that you guys know is critically important, and it is where these real estate developments are actually located, right? Location, location, location. So let's talk about geography. This gives you some kind of understanding of what we're looking at in the Detroit market, and probably even in some of your cities across the state of Michigan. in our marketplace, if we were really working in a fully stabilized city, we would actually only have a very simple capital stack. The first bar shows you where the owner equity would come into a project at about 20%, and then a bank would take over the other 75 to 80% of the project, right? And so you would have a very simple capital stack of just bank loans and owner's equity. The second bar actually is a reflection of what we see in the Detroit core, like the downtown market, the midtown market, where owners are coming in with less than 20% equity. We see the bank stepping in with the traditional 60 to 70% of lending capital. And then you have a CDFI that steps in and provides the subordinate debt into that project. So you may have a capital stack of $1 million project where the bank is providing 70% loan to value. You know, our CDFI friends come in and provide 20%, which is where we like to sit us in at Invest Detroit. And then our owners are coming in with a 10% investment of equity into a project. In our neighborhoods, what used to be the downtown area, we see projects where our owners are coming in with less than 10% equity, somewhere between 15 and 0 and 15% equity. Our CDFI friends are stepping into the markets because these are emerging markets, and our bank friends are not quite there yet, and working in those neighborhoods that hasn't had a proven track record of success. So our CDFI, like us, will step into those markets. A lot of times we're building those markets. Another CDFI may provide a sub debt to our as a senior lender. And there's still a gap between how much it costs to develop in that market and what is actually available for resources to get that project financed, and what the market will bear from a rent perspective. So there is a non-serviceable gap, and that is where we step in with what we see as a grant product or a subsidy product. And that's really how the neighborhoods are functioning right now. We're seeing that there is anywhere between a 20 to 30% gap in the marketplace where there isn't enough rent or revenues from those projects to actually service the amount of debt that's required to finish a project. And so we'll talk a little bit now about how we have to lend in neighborhoods like that and how CDFIs kind of function. We have a pretty aggressive goal to put about $250 million into neighborhoods that are emerging in Detroit. We've seen something like this work in the downtown area, so we're trying to move this into the neighborhoods. Our goal is to move into 10 neighborhoods across the city of Detroit, beyond downtown, and preserve about 10,000 units of affordable housing with our partners at another CDFI. The two of us have this goal. And then we want to create an additional 2,000 units of affordable housing. This is the strategy that we're undertaking. We're looking at the commercial corridors that are not strong now, but we want to continue to raise the market rents and the rates in those markets. We're looking at the parks as complements to these commercial corridors and any green space that will help us really create a vibrant neighborhood. The streetscapes, obviously infrastructure is important, making sure that we have strong infrastructure that support the commercial corridors and the greenways. And then density. Housing density is so important. So we have a model that we allow housing to be rehabbed as along the cores in which the commercial corridors that we're working. And lastly, I want to point out how we've gotten here. So the Strategic Neighborhood Fund, again, is a $250 million 5-year commitment to support 10,000 units of affordable housing, as well as revitalize these 10 neighborhoods with commercial corridors along with them. These are some of the organizations that have supported us along the way. As you see, I've got the hand claps next to our friends at Fifth Third, who's made a $2.5 million investment directly to Invest Detroit and to the Affordable Housing Leverage Fund. We have come very, very close to raising $60 million in total to help us put grant dollars into these neighborhoods who need these dollars to actually get these projects in those neighborhoods to work. So hands off to all of our corporate partners that help us do this. And I wanted to make sure that you understood that this is something that happens across the state with a number of our CDFI partners. You have to raise dollars from banking corporations and other corporations to actually lend the capital out in the marketplace and to grant the capital out to make projects work. So with that, I want to turn it over to Jason so he can talk about why it is that banks and corporate partners actually do this. We haven't gotten into talking about CRA lending, but I'm sure that within the next few minutes, you'll have a better understanding of why this is important to Fifth Third to help partners like us raise dollars for our loan funds.
Fantastic, Tasha, and well done. If you can stop sharing your screen now, and I'll start sharing mine.
I hope I did that right.
Perfect. Can you see my screen?
I absolutely can.
Perfect. So we've already gone through my bio. So as we talk about how we partner together, I think it's important for you all to understand who Fifth Third Bank is and what it is that we do as a financial organization. So we're one of the largest money managers in the Midwest with 171 billion, that's billion with a B, in assets under management. As a bank, we have 2,000, almost 2,500 ATMs throughout our 10-state footprint: Michigan, Ohio, Kentucky, Indiana, Illinois, Florida, Tennessee, West Virginia, Georgia, and North Carolina, with 54,000 fee-free ATMs nationwide. Say that fast 5 times. Fee-free ATMs across the country. And you'll see on the map there that we are expanding into other geographies with corporate offices. The dark blue shaded area on the map in front of you are the markets where we have our retail footprint and have responsibilities for CRA, or the Community Reinvestment Act, which I'll talk about a little bit later. And throughout those, throughout that 10-state footprint, we operate almost 1,200 or 1,150 full-service banking centers, 83 of those being in Eastern Michigan or the greater Detroit area. And we operate 4 main businesses: commercial banking, branch or retail banking, consumer lending, and wealth and asset management. And within those, we call them swim lanes. So commercial banking includes our business banking. So business and retail also includes business banking. So in our retail space, that's where we do all of our consumer lending, from mortgages, home improvement, car loans, home equity, personal loans, including small business loans for companies with revenues under 2 million. In our business banking swim lane, we work with small businesses for loans for companies with revenue or sales up to 20 million. And then in the commercial banking space, we work with companies with revenue or sales greater than 20 million in revenue. And so, and within that commercial space, we also have our commercial real estate segment, as well as our community development corp that really focuses specifically on community development, lending, and investing. Financial strength. So Fifth Third was established in 1858. Like I said, we have 171 billion in assets under management, 397 billion in assets under care, which includes 46 billion for individuals, corporations, and nonprofit organizations. And we invest in small businesses and communities, which I'll talk a little bit more about later. And that includes, so the investments that we've made with Invest Detroit and the other CDFI partners in this space would fall into that $32 billion number there. So I'm going to get a little bit granular on what it means to work with a financial institution, particularly in this space of community development and how we coexist or build the financial ecosystem with CDFIs and the likes of Invest Detroit and others working in the space. And so you taking a page out of our friend Dan Gilbert's book, Money Follows, It Does Not Lead. And so what I mean by that, so we go by, from an underwriting standpoint in the community space specifically, we go by the 6 C's of credit. Our traditional underwriting are the 5 C's of credit. I've added this 6th C to represent community impact. So what is the public welfare of the loan or investment that we're going to be making to the community? And so I've added this 6th C in response to the Community Reinvestment Act. And so the act itself is a federal law that encourages banks and savings associations to help meet the needs of borrowers in all segments, including low and moderate income, the low and moderate income segment. It was established in 1977 to reduce some of the prior discriminatory practices in low and moderate income neighborhoods, specifically around this idea of redlining. And so when we talk about community impact as an underwriting measure, we look at, does the project qualify for CRA credit? Is it in a low or moderate income census tract? Does the project help to stabilize or revitalize the community? What is the level of jobs that will be created by the project? And you heard Tosha talk about those exact metrics in how they look at projects. And so all of our investments with a CDFI such as Invest Detroit will automatically qualify for CRA credit because they've built this criteria into their underwriting. And then finally, from a community impact standpoint, is it affordable housing? How many units will be created? And we talked about the jobs, both permanent and temporary jobs. And we talk about CRA qualified. So what constitutes CRA qualified? From a community development activity is specifically defined. And there are several things that financial institutions do to support communities that do not qualify for CRA credit. So not everything we do qualify for CRA credit, but in this space, we are specifically looking for CD loans, community development loans and investments. The second C of credit that we go by in the banking space is cash flow or capacity. So whereas our CDFI friends might invest with a newer entity looking to develop in neighborhoods, we're typically looking to bank with or invest with, lend with more stabilized entities. So we look to finance the growth of the company or the growth of the real estate portfolio rather than the establishment, if that makes sense. And so what we're looking for is, what is your organization's borrowing history and track record of repayment? How much debt can your organization handle? Will you be able to honor the obligation and repay the debt? And there's a number of financial benchmarks such as debt and equity, debt and liquidity ratios that we use before advancing funds on any loan obligation. Character. So the banks want to put their money with clients who have the best credentials and references. Traditionally, we've looked at this as the credit report, right? You might also look at the Dun & Bradstreet, but we also look at how you treat your employees and customers, the way that you take responsibility and the timeliness of fulfilling your obligations as part of how we analyze the character of a borrower. And usually it helps to have had some history with the borrower in order to be able to analyze that character piece as well. Collateral. So while cash flow will nearly always be the primary source of repayment, we often look for secondary and tertiary forms of repayment, and collateral is typically the secondary source that we look for. And collateral represents the assets that the company either pledges that the company will pledge as an alternative repayment source for the loan. We look at liquid assets, we look at hard assets, and it can come in any form of real estate, office, manufacturing, equipment, residential units, you name it. If it's a hard asset, we will look at that as a potential form of collateral. In addition, we look at accounts receivable and inventory for C&I or operating businesses that can also be pledged as collateral. We look at capitalization. So how well capitalized is your organization? How much money have you invested or reinvested back into the organization in our lending decisions? And then conditions. What are the current economic conditions and how does your organization fit into those current realities? We look at the micro scale as well as the macro scale. If your organization is sensitive to economic downturns, the bank wants to know that you are good at managing productivity and expenses. We call it through the cycle, right? And so we like to be a through the cycle partner with our customers. And so we look to partner with organizations that can manage through the cycles. So our commitment, as we look at, I talked a little bit about what we've done from a lending standpoint and how we go about looking at our lending parameters. And I want to talk a little bit about more about our $32 billion commitment that we made 5 years ago. We are actually in the 5th year of that commitment, and year to date, we're actually higher than that 316 number. We're actually somewhere in the neighborhood of 330 million, or I'm sorry, $330 million through these various programs. So LMI mortgage lending, small business loans, community development loans, community development investments, and charitable donations. We also participate a lot in the community through board participation and volunteerism. And so almost 6,000 hours to support community organizations as of the last fiscal year. And I've highlighted here a couple of key projects that we've invested in that may be familiar to some looking at this. So Sanctuary Limited Dividend Housing, LLC, Connect Detroit is one of our economic development partners, as well as Michigan Women Forward and a couple other organizations. And then services that we provide to low and moderate income families. So we work with folks like the Torch of Wisdom Foundation, the Rocket Giving Fund, and the NAACP. Next, going to kick it back over to Tosha just to have a conversation about COVID. So we've talked a lot about the state of things pre-COVID, and just want to get into a conversation about how have the responses been, or what has changed in the age of COVID. And I'm going to stop sharing my screen. So Tosha, at Invest Detroit, what has changed for you guys in the age of COVID?
Yes, thank you for the question. Can you hear me out there? Good.
Yes, yes.
Good, good, good. I'm going to just refer, I think it's a great question to start this conversation off with, back to looking at this one slide here. Hope you can see this. One second here, get you loaded. While we're waiting for that to load, did you see that, Jason?
Yeah, it's not, it hasn't popped up on the screen yet. There it is.
Okay, there it is. I think that's it. So when we think about looking at this from a perspective of the marketplace, right? And so this is what our market looks like. Oh, we're not connecting the way we want here. I'm going to leave it there. When we think about the perspective of this where we are in the marketplace of the Detroit downtown core and the neighborhoods and the the non-serviceable gaps that we're in. This was before COVID, right? This is a snapshot of what our marketplace looked like in the Detroit core and the Detroit neighborhoods before we had these huge development gaps. The market was depressed, and I'm pretty bullish, and so is InvestUtrade and a number of the CFIs on what's happening in the marketplace post-COVID, right? For us, we see the movement of people being more densely populated and spending more time at home as a win for neighborhood businesses. And so for us, we've actually gotten a little bit more aggressive in what we're able to support in the marketplace. So I want to switch down to show you a couple of things that we're doing here. When we think about the neighborhood lending, we actually are requiring less owner's equity to come to the table. We recognize that a number of folks who want to work in the neighborhoods and support their, their commercial cores where they live and work are minorities. As the city of Detroit is over 80% Black. And there are women who want to support those neighborhoods and want to see a difference in those neighborhoods. So we have actually gone deeper into the marketplace, requiring less equity and providing rate reductions for our minority and women borrowers. As a result of that, we have also been more aggressive on how long we'll amortize those loans. So in the past, anywhere from 20 to 25 years is what you would normally see in a traditional banking deal. We're looking to extend those terms even longer than that for amortization periods. And then we're, obviously sensitive to the fact that a number of our small businesses have been closed. So right at the beginning, we supported through efforts with our banking partners who provided grant dollars and very flexible terms to us as a borrower of them. We have been able to do some debt relief in the form of loan deferrals and debt relief in the form of interest only to those small businesses that cannot be open, provide services during this period of time. So for those who have been able to survive or be open during the COVID, they've actually seen, I think, record sales. A number of our small businesses, restaurants included, I'm sure as you think about yourselves across the state and where you're shopping and how your shopping habits have changed, local businesses have seen an uptick in a number of our neighborhoods. So it has allowed us to be more aggressive in that way. When we think about the downtown market now, this is, I've kind of shared a couple of things over here on the side about the downtown lending market. Now that we don't have that density of office space and the density of people who are occupying those offices in the downtown area, we've actually had to be more conservative about how we've done some of our lending. So we're actually requiring our owners to support with more equity. And then what we've seen in the downtown core, where we were looking at 5 to 10%, we actually are looking for them to take a bigger stake in their projects if they're going to go into the core. We're very sensitive about absorption in the downtown areas now, given that people are spending more time in the neighborhoods in which they live now. And then we're also very sensitive to, the fact that there are less businesses operating because there aren't the density of people in the downtown area. So that means that we've had to go deeper into the debt relief space for loan deferrals and deeper into the debt relief space in the form of doing more interest only terms for our developers. On the flip side, on the positive side of what's happening downtown, construction projects are back on the way. They're happening. So we still have dollars going out the door for construction projects, which has been a slowdown at the beginning, but we're now seeing a lot of construction projects for deals happening all over the city. So that's kind of where we are in the COVID space. We have a number of CDFI partners and relief programs that are happening all over the city that we try to get the word out to our borrowers about so they can take full advantage of it. Wayne County and the city of Detroit and any other relief programs, we either support by, coupling other dollars with them, or making sure that we help our borrowers get those dollars into their hands to help with their projects. So that's what it looks like for our organization and some of the CD5Is across the town. Jason, what has been the response on the traditional banking side, or as you see it from Fifth Third's perspective?
Yeah, so thank you, Tosha. And I'm going to share my screen again here as well. So on the banking side of the house, so one of the first things that we did, can you see my screen there, Tosha?
I sure can. Yes, this gives me some perspective. Yep.
Beautiful. So one of the first things that we did was to set up this help page on our internet site at www.53.com/COVID-19. And in there, if folks need help and resources, we have populated that website with support, COVID support for personal banking, business banking, commercial banking, as well as what we've done in the community. And the approach that we've taken, I call it the 3 C's: colleagues, clients, and community. So our first area of focus was on our colleagues, and wanting to make sure that the health and safety of our colleagues was our clients, and the community, right, was of utmost importance. And so this to me has been one of the biggest examples of we're all in this together that I think I've ever seen in my lifetime. And so I like to share about what we've done in this space, because a lot of times when we work with customers as a money lender, folks forget that we're a business too, right? And so I like to point out the fact that, that we do have retail locations, and we want to make sure that just like all of our business partners, that our colleagues are healthy and safe as well. And so we immediately moved our branches to drive-in only with lobby appointment visits. And all of our in-person financial education and community service efforts that we were doing were either canceled. Well, they were initially canceled, and then they all quickly moved to virtual, like what we're doing here on this Zoom today. I tell you, we really learned, upped our skills on using these virtual sessions during this time, and I don't think that's necessarily a bad thing. Once we have, and then we sent about between 50 and 75% of our workforce that could, we sent them to remote working, so working from home, and I fall into that category and continue to work from home. As we began to open back up and some of the shelter-in-place restrictions had been lifted, we enhanced our office cleaning protocols, installed clear panels like you'll see in a lot of retail establishments in face-to-face customer-facing locations today. We implemented social distancing, enhanced hygiene practices with regular use of hand sanitizers and hand washing in our branch locations, and continue to grow our team's capabilities for remote work and capabilities. One of the things that I was sharing with Tosha before we jumped on to begin recording was the fact that, prior to this shelter-in-place order, at the bank, we didn't have access to Zoom. And so that was one of the things that that enhanced our capabilities, was really giving us access to all of the tools that we can use for working from home situations. The second C in my 3C paradigm are our clients. So we wanted to ensure that our clients had, in addition to the health and safety factor, but we wanted to ensure that they had some modicum of stability. So we worked to establish forbearance and relief programs for our commercial, small business, and consumer clients so that they wouldn't have to worry about payments and collections as we got used to this new normal. And so as we, began to see the economy and businesses come back online and the economy starts to stabilize, we continue to field forbearance or hardship requests from our clients as we work through this together. We also work with the Small Business Administration to fill PPP loan applications, so the Payroll Protection Program loans through the Small Business Administration. And we actually, across our footprint, we were able to process and close approximately just in the neighborhood of 45,000 loans through that program. And so a really robust set of dollars that we were able to deploy in the community to assist our small businesses and commercial clients. And then community, the third prong of my 3 C's is community. So we knew that as we all moved to shelter in place from the pandemic and the loss of business and jobs, that many in our community would suffer the basic necessities of life. So we moved promptly to respond, and we established what we call our COVID Relief Fund. And I'm going to throw another set of acronyms at you, the 3 R's, focused on the 3 R's: relief, recovery, and resiliency. And so under the relief umbrella, we established a $3.25 million immediate emergency needs fund for food, shelter, utilities, and small business support. And we've actually worked with a number of our CDFI partners to provide emergency support to some of the small businesses that we were unable to get to utilizing the PPP program for any number of reasons. And then we established an additional $5.5 million in our Strengthening Our Communities grants to support long-term sustainability, including, again, support for small business, affordable housing, and home ownership and economic development priorities. And so I went through a lot there, Tosha, but the main point that I want to get across is that we tried to focus across the spectrum, making sure that we touched on both our clients, our colleagues, and our communities in responding to the COVID crisis.
No, I really appreciated you giving me that perspective. And I'm actually going to punt one little question based on that. What has been the most encouraging space that you've seen some growth happen during the COVID? Because from every crisis, we see opportunity. And I know that you've seen some opportunities. Has there been an area of the bank or an area of industry that has grown as to your perspective as it relates to what's happening right now?
From my perspective, I would say probably the biggest area, I wouldn't say of growth. Our small business area continues to do a great deal of lending right now. As you might imagine, and I'm going to go back in my presentation as well, as we think about the C's of credit that I talked about, right now, we're across our portfolio. And if you think of the bank in terms of the lending and investing we do, and you do the same thing at Invest Detroit, we look at it on a portfolio level, right? And so across our portfolio, we're really paying attention to the current conditions. So the economic conditions, both micro and macro, and really trying to get a bead on, how folks are going to come out of this thing, right? In their ability to come out of this thing. So looking at our affordable housing or our rental real estate portfolio and looking at delinquencies or the ability of folks to be able to pay rent as unemployment ticked up on us. And we're starting to see that tick down. And so we're really paying attention to the macro level of economics. And then on the micro scale, and you talked about it earlier in your presentation, Tosha, and thank you for the for the shout out on the investment in the Strategic Neighborhood Fund. But we're really focusing on our neighborhoods here in Detroit to ensure that the people in the neighborhoods are taken care of during this time. And so we work in the Gratiot 7 Mile neighborhood specifically, and our actual commitment to the Strategic Neighborhood Fund was $5 million all in, 250 going to, or 2.5 million, I'm sorry, 2.5 million going to you guys, and then 2.5 million going into the Affordable Housing Leverage Fund. But we're really focused in on making sure that that our clients in those spaces are able to, again, weather the storm and operate through the cycle. How about you? Where are you guys seeing growth in the space right now?
So you actually covered it in your presentation as well about community loans and the differential between InvestiTrade and CDFI partners, and what we will look at, which is, new entities and startup entities and startup companies. Those are where we're seeing kind of get their legs around each other in the neighborhoods, right? We're not seeing, new chains happening, coming, new like chain stores coming to the neighborhoods per se. So what we're looking for and what we're starting to see is more people taking interest in creating their own, franchise or creating their own organization within the neighborhoods. And so there's been an uptick of, interest in creating a business or even starting something during this time. We had a pretty healthy pipeline of activity before COVID, and we continue to fund those organizations and small businesses during these times. Obviously, we're very cautious about their timing and when they're open. It's always hard to build a name and market during a time of uncertainty. But at the same time, we're supporting them in their zeal to create something new in the marketplace. We're also seeing a growth in the industrial space. And my guess is that's one of the spaces that you're also seeing some growth as people are looking to shop online for their goods. There needs to be a place for them to place those goods for big companies to grow. So we're seeing an interest in industrial picking up in the city place in buildings that have not been activated in a long time, which is encouraging. So we continue to help those businesses that are feeling some hardships, and we continue to help those businesses that are seeing an opportunity to grow.
That's excellent. And we certainly appreciate our partnership with you. As we wind down our time here, I appreciate the opportunity to share this time with you this afternoon, Tosha. And I've thrown on the screen my contact information for folks that wish to get in contact with me. Again, I'm Jason Paulateer at Fifth Third Community and Economic Development, and I can be reached at 313-230-9774 or email at jason.paulateer@53.com. Did you have a slide you wanted to throw up with your contact information, Tosha?
You were a step ahead of me on that. So, no, that's great. I'm glad that you did. But for those who are listening, I can share vocally what I have as an email contact. And that is Tosha, Tosha, .Tabron, Tabron, at investitrade.com. And that is Tosha.Tabron at investitrade.com. You can always go to our website as well at investitrade.com and find all of our information for not just only my contact information, but all of my colleagues, my 33 colleagues who work across our footprint at InvestiTrade as well. And look at that. Thank you, Jason, for making sure that's present for you guys on the screen to take a great picture of if you need to.
There you go. Awesome.
Thank you for sharing your evening with us. We really appreciate it.
And I think that's a wrap.
I think that is too.